For Morningstar, I'm Jeremy Glazer. I'm here today with stock investor editor Matt Coffina. We're going to talk a bit about his recent purchase of Time Warner and why he thinks it's well positioned in a changing media landscape. Matt, thanks for joining me today.
Thanks for having me, Jeremy.
So you've talked in the past about how media is kind of undergoing this secular change right now, going through a lot of different changes. Can you just tell us a little bit about what some of those changes are?
Sure, I definitely wouldn't downplay the changes that are going on in media, and I think this is really a once-in-a-generation shift driven by technology. So we've had already for a number of years digital video recorders, which enable consumers to skip through advertisements, for example. Somewhat more recently, over-the-top services like Netflix that enable you to watch exactly what you want, when you want, over the internet. Increasing trend toward on-demand watching in general, where consumers are not necessarily sitting down to watch a show at any given time. They just want to record it or get it through an over-the-top service and watch it when they want. And this is going to have profound impacts, in my view, on the media industry. And I think there'll be winners and losers. And I bought Time Warner recently for our hair portfolio because I think it's going to be among the winners. I think it has one of the strongest moats in media and is right up there with companies like Disney and to a lesser extent Fox as having a relatively strong competitive position.
Let's take a deeper dive on that. One of the threats is certainly the decline of traditional advertising. Why do you think Time Warner is better positioned here?
Yeah, and I'm a big believer in the shift to digital advertising. It won't happen overnight. You're not going to lose all of the advertising that's spent on TV and have it all go to digital. But we own, for example, Google and Baidu in the hair portfolio, and that's a play on digital advertising where we think steadily over time digital ads will gain share from traditional media, and TV advertising in particular, which has been largely untouched until now, I think is going to start to gradually give way to more digital advertising. The good thing about Time Warner on this front is that advertising is only about 16% of revenue, overall revenue. So that's definitely at the low end relative to peers. You have other companies like Discovery Communications or Scripps Networks that are much more highly dependent on advertising. It might be 50% of their revenue. Also companies that own broadcast networks in general, much more dependent on advertising. Time Warner, in contrast, gets more affiliate fees, HBO subscriptions, content licensing fees from Warner Brothers, and so those revenue sources, I think, are much more insulated from this shift in advertising spending. So, advertising, I don't have high hopes for growth, but even if advertising spending steadily loses a percentage point or two of share every year, the overall ad market is growing. So we might still be looking at stagnant ad revenue. It's not necessarily going to outright decline. It might just lose market share steadily to digital over the years. And then the fact that it's a small percentage of Time Warner's overall revenue is what really gives me confidence to say that it's a headwind that can be overcome.
We've seen an increased number of clashes between distributors and the content producers. Do you think Time Warner has the upper hand here? Do people need their content?
Yes, this is definitely another trend that we're seeing. Distributors consolidating within themselves. We're seeing, Time Warner Cable potentially being acquired by Charter, for example. And then just in general, I think consumers are getting increasingly frustrated with cable bills that go up every year by mid or high single-digit percentage. And so the distributors are finding it necessary to push back against the consistent rate increases of the content companies. And the best way that they, or the best tool in their toolbox for doing that is to exclude channels altogether. And so I think we're seeing a rise of more narrow content bundles. We saw it, for example, with Dish's Sling TV. We saw Verizon trying to break down the bundle into smaller parcels and give consumers more options to not pay for content that they don't want or that they're not watching. And so Time Warner's advantage is really that they own what I would consider must-have content. And so we're talking most specifically about the Turner segment. So they own TBS and TNT, which are both top 5 basic cable networks. Cartoon Network, which includes Adult Swim, which is very popular with the younger demographics, CNN, which is declining in ratings and struggling with some competition from MSNBC and Fox News, but still a very solid franchise and very solid internationally, especially. And then they can combine that with HBO as well. And I think Time Warner has a very compelling package of content to offer to distributors. And at the same time, they don't have a lot of these lesser watched channels that they're trying to push through as well. So they can focus more on these high-quality channels, and they really are must-have for distributors. So in Sling TV, for example, we see TBS and TNT are included in that package, as is Cartoon Network, CNN. And I think in general that Time Warner's channels are going to be some of the last ones that you're going to try to exclude from a narrow content bundle. and if consumers aren't willing to go without those channels, that really gives the bargaining power to Time Warner, more so than somebody with weaker channels that are more easily excluded from the bundle.
Are you concerned about the risk of fragmentation in the media landscape more generally, that maybe people don't want to watch shows on any network, they're going to get them elsewhere? Do you see that as a big long-term threat?
Yeah, so there's definitely concern about the breaking of the bundle. So are people going to not need traditional cable bundles anymore, and what does that do to the content companies? I think the overall demand for video content is actually only increasing over time. If you think about it, people are basically carrying around little TVs in their pockets nowadays in the form of smartphones, and they have their iPads around the house, and they're able to watch TV anywhere at any time. So I think the demand for video content will always be there. Don't forget also that the typical household in the U.S. watches some crazy amount of TV, something like 5 or 6 hours a day of TV per household. And so that's not easy to replicate with a service like Netflix. Certainly there are some millennials that maybe are just watching Netflix and complementing it with Hulu or YouTube or things like that. But I think the vast majority of households are still going to want some kind of content bundle, regardless of how it's delivered, whether it's from a traditional cable company or whether it's over the top, something like Sling TV. I think the vast majority of households are still going to want some kind of bundle. We're seeing overall pay TV subscribership isn't growing anymore, and it's even shrinking a little bit. But it's going to be a very gradual shift, and I think Time Warner, again, with the very strong channels, is going to be able to get those channels included in whatever bundles come about. It also has an opportunity through HBO to go direct to consumers in an over-the-top way. And then at the same time, Time Warner, with its relatively strong bargaining position, should be able to continue increasing its affiliate fees more so than somebody with weaker channels.
You mentioned that standalone HBO. Is that one of the primary potential growth drivers for the company?
It's very hard to handicap what might happen with HBO, but I think HBO already has a great suite of content. They have exclusive rights to all the movies from the major studios, not just Warner Brothers, but also 20th Century Fox and other Universal, I think, as well. A lot of the major studios, HBO gets their movies first after they're out of the theaters. And then on top of that, HBO, of course, with its very popular original content, right now it's Game of Thrones that everyone's talking about, but definitely some, and then of course the library of past content, The Sopranos and all the hit shows of the past. So I think HBO has a very compelling offer for consumers. And it's sort of very hard to handicap at this point how big that could be, but I think it certainly has the same kind of appeal as a Netflix, and I don't think these services are mutually exclusive. I think the more you see people cutting their bundle, abandoning the traditional cable bundle, the more likely they are to pursue multiple of these over-the-top services. So maybe they'll subscribe to Amazon Prime and Netflix and HBO, and that'll be their bundle. And again, I think Time Warner is better positioned than the vast majority of media companies to preserve its role and preserve its economics of its particular channels. Versus some weaker peers.
So if the company is in a good competitive position, what does that mean for valuation? Why are the shares trading at a discount right now?
Sure. So I think the shares are very reasonably valued. When we purchased Time Warner, it was trading at about 18 times earnings. Our analyst is forecasting mid-teens earnings per share growth. And it's very hard to find a company with that kind of growth trading at that kind of multiple in the current market. So we think they can get there through just mid-single-digit top-line growth, call it 4 or 5%. Again, that's mostly affiliate fee growth, HBO growth, Warner Brothers, and so on, not so much from advertising. On top of that, they've consistently expanded margins in recent years and continuing to find ways to do that. It's a very leverageable business model. Once you have quality content, you can just sell it over and over again and send it out through different channels. A great example would be Friends, which went off the air over a decade ago. Warner Brothers just, besides rerunning the episodes on TBS and so on, Warner Brothers just relicensed Friends to Netflix. So, you still have I Love Lucy on TV 50 years later. So in some cases, this content has a very long life, and once it's produced, it's just basically pure margin. So I think they can continue to expand their operating margins over time. And then on top of that, it's a very cash flow rich business. So they've been repurchasing 4, 5, 6% of the shares every year. And maybe that'll slow a little bit because they have a fair bit of financial leverage at this point. But I think that will continue. And then the shares also pay a decent dividend, a little under 2%. So all those things combined, I think, make for a very attractive total return profile and a very attractive valuation. And the best reason I can give you that they would be trading at that valuation is these concerns about disruptions in media. And I think we see a wide spectrum of valuations in media right now. So you have, for example, Disney trades at more than 20 times earnings, and then you have Viacom trading at barely 10 times earnings because its content is perceived as lower quality. Time Warner definitely fits somewhere between those extremes. But again, if you believe in the economic mode and you believe that it's a defensible business over the long run, I think it's a very attractive valuation.
Matt, thanks for the update today.
Thanks for having me, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.